Hey, welcome back.
Glad to be here.
So listeners, today our mission is exploring three distinct shifts in the Korean business landscape based on the Seoul Economic Daily front page. We're looking at the structural shift toward ETF investing, capital flows ahead of a major aerospace IPO, and a corporate M&A in the streaming sector.
Right, there is a lot of movement happening right now.
Yeah, so let's start with a macro view because the way retail capital is deployed in Korea is just fundamentally changing.
It really is. We are observing this distinct structural move away from picking individual stocks.
Which is like, deciding that instead of trying to pick a single winning horse, you just buy the entire racetrack.
That is a perfect analogy, and the data from Korea Investment and Securities illustrates this very clearly.
Right, I saw that data. As of March 20, 2026, ETF balances in regular stock accounts reached 15.79%.
Yeah, which is a notable increase when you consider it was at just 5.58% in 2023.
That is almost triple. And the March daily average ETF trading volume actually reached 20.3992 trillion KRW.
Exactly. And the underlying mechanism.
Yeah, Reuters is reporting that SpaceX is preparing for a mid-June IPO. They're aiming to raise $75 billion at a $1.75 trillion target valuation.
Which is a very significant target.
Yeah, and according to ETF Check, retail investors poured 45 billion KRW into Codex U.S. Aerospace and another 8.3 billion KRW into 1Q U.S. Aerospace Tech over just a single week.
Right. They are utilizing these vehicles to get ahead of the IPO.
Wait, hold on, though. I mean, aren't retail investors basically utilizing a regulatory loophole here? Because Korean pension accounts strictly prohibit holding unlisted stocks.
Well, it is a structural workaround, yes. Funds are using overseas ETFs, specifically tickers like ROMB, to gain indirect exposure to private equity.
Okay, so buying the overseas ETF gives them a proxy stake.
Exactly. And Korea Investment Management plans to launch an active ETF in April to rapidly adapt to the eventual listing.
Okay, so that is retail money chasing aerospace valuations. But on the corporate side, strategic investors are hunting for terrestrial bargains in distressed domestic tech assets.
Right. The streaming sector is seeing some major consolidation.
Yeah, CJ ENM just submitted a letter of intent to Samsung KPMG to acquire the first-generation OTT platform, Watcha.
And Watcha entered court receivership last July.
Right. And their valuation fell from over 300 billion KRW to around 10 billion KRW.
Which presents a very specific opportunity for a corporate buyer.
Honestly, it is like buying a financially distressed luxury car solely to harvest its pristine engine.
That is a great way to frame it.
Because the engine here is Watch's curation algorithm.
Exactly. I mean, Watcha lost ground to global giants like Netflix.
Right. They couldn't compete on that scale.
Yeah, but their curation know-how and the user data they have accumulated since 2011 remain highly valuable.
So for strategic investors, acquiring that algorithm is a highly cost-effective method to improve their own content delivery systems.
Right. It lets them bypass years of expensive internal research and development.
Well, folks, that leaves us with a final question to consider. With retail investors demanding stability via ETFs and corporations acquiring former tech unicorns at steep discounts, are we entering a market cycle where only the hyper-diversified or the deeply consolidated can thrive?
It is definitely a structural dynamic to watch.
That's all for today's deep dive.
We'll be back with more insights.
You've been listening to the Korea Economy Brief, straight from the front page of Seoul Economic Daily. Thanks for tuning in.